Thank you so much, Rama. As you say, I've been at Stanford forever, but that hasn't prevented me from visiting you many times in Europe and in England. And I recall many happy hours together talking about science and everything else. I'm here today with one of my collaborators, Zachry Wang, who you'll see somewhere on your screen. Zachary's in our PhD program. I'll tell you about some of the work that he and I are doing in a few minutes. My other collaborators are Professors Antje Berndt and Yichao at Australia National University, where it's the middle of the night, so they're not going to be joining us today. Before showing you some slides, I just want to catch you up for those of you that have missed the previous episodes of this drama. As Rama said, the drama sort of begins with a famous manipulation of LIBOR, which is still the most referenced benchmark number in the world, underlies hundreds of trillions, literally, of financial contracts. And to speed through the previous episodes, the official sector decided that something needed to be done. It commissioned a number of studies and reform groups. I chaired one of those studies for the Financial Stability Board. Out of the end of this process came, for each major jurisdiction, each currency zone, new endorsed benchmark rates. And those of you in the United Kingdom know that for the UK, the new rate is SONIA, which is now officially fixed by the Bank of England. It's a short-term, nearly risk-free rate. And in the United States, the officially backed rate, backed by an industry group called ARC and the Federal Reserve, is called SOFR, the Secured Overnight Financing Rate, which is an overnight repo rate. Both SONIA and SOFR are risk-free rates and have no term spread in them, but nevertheless have great promise as reference rates because they're so robust. They're not going to get manipulated because there's a ton of transactions underlying them, and they're fixed by the official sector. So they're quite safe and sound. However, unlike the UK and the EU, which have legislation for benchmarks, the United States, as you may have noticed recently, is the land of the free and the home of the brave, which means that not everybody is going along with the plan. There are divisions among the banks. There's a subset of banks that is saying, wait a minute, what's this about an overnight risk-free rate? That means if we write our bank lending contracts linked to SOFR, then when credit spreads go up and our funding costs, our costs for obtaining financing go up, our loan revenues will not go up because they're only linked to an overnight risk-free rate. And we will have a problem relative to where we were before when our contracts were linked to LIBOR, because one of the great things about LIBOR from the viewpoint of banks is that when bank funding costs go up, their loan revenues go up because their loans are linked to LIBOR, which is unsecured 3-month or 6-month cost of funds for banks. And that brings us to today's episode in this drama, or nearly so. These banks that were not so happy with SOFR pleaded with the US official sector to help them with a alternative to SOFR or an add-on to SOFR that would add back the credit spread that SOFR is missing so that banks would be enabled to link their loan contracts to their funding costs and thereby offset some of their funding costs when credit spreads go up. I was invited to join in the meetings of this group of banks and the Federal Reserve Bank of New York. This group is called the Credit Sensitivity Group, CSG, and they've had a series of meetings over the last year regarding what is this about a new credit spread benchmark? What should it be if we have it? Should we have it? Is it important? And I'm going to talk mainly today about an idea for how to do that I developed with Antje Berndt and Yichao, which is called an across the curve index. And then towards the end of the talk, I'll also tell you why Zachry and I think that the addition of a credit spread index, whether it's the one I'm going to mention, AXI, or some other credit spread index, whether it would actually make lending markets more efficient because of this effect that some banks are complaining about. That is, would it be helpful to banks and would it make lending markets more efficient if their loan contracts could be linked to a credit sensitive rate rather than just an overnight risk-free rate? So that's a long preamble. I'm going to show you some slides, and Rama says we'll have time for Q&A as well. I'm going to make sure I leave that amount of time. I'm going to share my screen now and start showing slides. So if you have questions, I think Rama is entertaining questions in the chat. So again, the main focus today is an across the curve credit spread index filling the gap that some banks in the United States are complaining about after the end of LIBOR. By the way, LIBOR, as you probably know, its life has been extended to mid-2023, but new contracts referencing LIBOR are not supposed to happen after this year. Let me repeat, at the end of this year, banks are not supposed to write new contracts that are linked to LIBOR. Nobody is. That's the plan. So what do we do instead? What other credit spread indices could we use, if any? So let's talk about what are the criteria that we would be looking for if we were to develop a credit spread before I talk about any specific choices. A moment ago, I mentioned that banks are concerned about their costs of funds, and they want to hedge their costs of funds with their loan revenues. And so they would like their loan books to be linked to a credit spread index. And so for that to work, the credit spread index needs to be, in fact, correlated with banks' costs of funds. Now that's an issue because one of the problems with LIBOR is that banks are not obtaining their unsecured funding at 3 months anymore. It used to be the case that banks' cost of funds was highly correlated with LIBOR. Nowadays, banks have termed out their funding to much longer maturities, much of the funding. And the average cost of funds or credit spreads on bank funding are not highly correlated with LIBOR. So we would want to get an index that's somehow correlated with the average costs of marginal funding for loans. That's coming up. The second thing that we would want on my list of criteria is robustness, meaning as opposed to LIBOR, which has not enough underlying transactions and can be easily manipulated, we want our credit spread index to have a whole lot of underlying transactions so that it's very robust statistically and it's difficult to manipulate. And the third thing that we would like is something that allows this credit spread index to move as banks change their approaches to funding. So as I mentioned earlier, regulation has termed out bank funding from 3 months to longer maturities. Maybe it will come back in again. Maybe it will, the mix of funding across maturities will change. Ideally, in order to be correlated with actual funding costs, the index should be adaptable. It shouldn't have a fixed composition of maturities. So I'm going to try to propose an approach that meets all three of these requirements, and it doesn't look like LIBOR, as I will show you. Here is, I'm going to explain this diagram in detail later, but here is an idea of what this credit spread index would look like in the black line on this chart, which starts at about 35 basis points in December 2017, and it fluctuates with bank funding costs over time. The black line is the average of the red line above, which is long-term funding costs, an index that I'll explain in more detail on the next few slides, and the blue line at the bottom, which is short-term funding costs. And so the average of the two is the black line. That's a prototype, a beta test, or maybe an alpha test of the across the curve index that my collaborators Antje, Yichao, and I have proposed. And what I'm going to do is I'm going to tell you how the red line and the blue line are constructed. And then already you have the idea, which is that the proposed index is an average of credit spreads across the curve, meaning across the maturity curve from 0 to 5 years, based on weightings that depend on issuance and transactions volumes. I'm going to explain all that. Now, at the short end of the curve, the blue line, we don't have data, and data is a real serious problem here, but fortunately, ICE benchmark administrators has given us some aggregates of their data, and we were able to combine them to give you the blue line as a rough estimate of average credit spreads on bank funding, large bank funding costs, from the maturities of 0 to 1 year. So that's basically, 1 day, 1 week, 1 month, 3 months, 6 months, and 1 year. And if you average across the curve based on issuance, you get something like that blue line. I'm going to focus on the red line because we do have data for the red line. Here's the red line again, going back to 2014, compared to LIBOR. And to make the comparison easier, I've scaled the red line so that it has the same mean over this sample period as the spread of LIBOR over the overnight risk-free rate called SOFR. So you're looking at two credit spreads. One is a 3-month credit spread, 3-month LIBOR over SOFR in blue. And the other is the long-term credit spreads from 1 year to 5 years, scaled so that it has the same average credit spread as LIBOR. The scaling will allow you to see that the red line and the blue line are not that highly correlated. Now, amusingly to me, some people say, aha, this means that your red line is not very good because it's not very much like LIBOR. And I would in turn say, aha, you got the wrong idea, because the red line says that bank funding costs are not very much like LIBOR. You really want something more like the red line. That is, if they're actually funding at the red line, why would you try to use the blue line as an index for your loan revenues? You'd rather have the red line. So this is a feature, not a bug. Let me explain how you would take this average cost of funds and embed it in your lending contracts. So if Rama was my customer at my bank, let's say Bank of America, and he came in the door, he's a corporate customer, he wants to borrow money on a floating rate for 5 years. In this new world with a credit spread add-on, I would say, Rama, here's going to be the 3-month loan interest payments for the next 5 years. You're going to pay me every 3 months SOFR for the 3-month period. And we can talk about how that's calculated, but it's basically an average of overnight repo rates. Then you're going to pay me a fraction of my marginal cost of funds, which is AXI, that's the X. And we're going to make that fraction part of the terms of your loan contract. And we can discuss how big that fraction should be. We don't want to charge you for our entire credit spreads for a number of reasons, including which long-term credit spreads are much bigger than short-term credit spreads. So we're only going to charge you a fraction of our long-term or across the curve average credit spreads. That fraction is given by a scaling coefficient Bn, which depends on the 3-month maturity. And then because, Rama, your credit quality is so good, we're only going to charge you a borrower fixed spread of 150 basis points. So you should feel very pleased that we're giving you such great loan terms. And then Rama can go and shop at other banks and decide whether our floating rate loan contract is attractive or not. Now, if Rama takes down this 5-year floating rate loan, he may want to eventually swap it to fixed. And for LIBOR, that's easy. You just call another bank and you say, oh, I have a floating rate loan contract. I want to swap it to fixed, so I need to enter a fixed for floating interest rate swap. And the bank will quote you a fixed rate, and now you've got essentially a fixed rate loan all in. If you have an embedded credit spread in your floating rate contract, then Rama will need to get another swap to swap out of the floating rate. And what this means is whatever the credit spread is, whether it's ours or anybody else's credit spread, you need to have a derivatives market that will allow anyone using that credit spread to hedge the floating rate interest expenses associated with it. It could also be used to speculate. So in the new world, not just with our proposed index, but with any credit spread index that the market develops, there will need to be derivatives that are indexed to that new credit spread. And there are various proposals for credit spreads, like Bloomberg has a new option for that, which looks pretty good. That might be the one that's chosen. Whatever it is, there's going to need to be derivatives on it. And that also implies that whatever it is, it needs to be very robustly determined by transactions data, because you don't want to get back to the situation we had with LIBOR, where there was so much derivatives written on LIBOR that there was very strong temptations to manipulate LIBOR. And you've all heard about that in the United Kingdom, because there have been legal cases abounding in the United Kingdom and the United States about manipulation of LIBOR. So that's basically how any credit spread index, including the one we're proposing, would be applied in bank lending contracts and would be used in derivatives contracts, whether to hedge bank loans or to speculate on bank costs of funds. What I want to do now is to tell you a little bit about how our credit spread proposal is constructed, and then talk about what are the economics behind this. Why do we want to do this? Why is it that those US banks are suggesting that they would like to reintroduce a credit spread once LIBOR goes away?
So just a question, there's no term structure here, right? In what you're showing on this slide.
That is correct. What you're doing is you're scaling with a constant coefficient an average of credit spreads X across the curve. So X is a floating index, Bn is just a scalar. So you're not providing a different credit spread for each maturity, except in the sense that you're scaling the same floating index. And that strikes some people as quite strange. But after all, the banks are not obtaining their funding at one specific maturity. So if you want to use their average funding costs, then you're not going to have a maturity specific credit spread. And if it's an average across all maturities, you're probably going to want to scale it so that it's representative of, it represents a level that's working from the viewpoint of hedging, and also working from the viewpoint of the borrower being willing to accept that much volatility. And this is, by the way, this is the part that is the biggest disadvantage of the proposal that Antje, Yichao, and I are making, which is that it's the same credit spread for all maturities, and that strikes some people as very strange. So getting familiarity with that is going to take some time. By the way, people getting familiar with compounding SOFR daily over a 3-month term was initially viewed as a non-starter. When I started working on this, people said, no way, we're never going to accept a 3-month rate that's the average looking backwards of the overnight rate. Nobody will go for that because you don't know your loan interest expense until the end of the quarter. But now it's commonplace, including in the United Kingdom with Sonia. The United Kingdom, by the way, does not have this issue of the banks seem to want a credit spread add-on, and I'm not sure why that's the case. The UK banks are in an orderly fashion adopting Sonia. Okay, now I'm going to give you the construction of the cross the curve index that we're talking about, which is called AXI. So now we're going to take X as a very specific construction. And this is a prototype. This is not the final construction. All the parameters are subject to change, but this will give you an idea. So what is AXI? It's an index which is the recent cost of US dollar wholesale unsecured debt funding over risk-free rates for publicly listed US bank holding companies and commercial banks. So more specifically, it's an average of credit spreads where the average is across maturities in each maturity bucket M, the spread to be averaged is the volume-weighted median credit spread across all secondary market transactions in the trailing month. And the weighting coefficient QM is the fraction that exists in maturity bucket M of total issuance by banks in the previous year. So if banks issued, for example, 10% of their unsecured funding in the 4 to 5 year bucket, then QM would be 0.1. And if the average credit spread of banks in that 4 to 5 year bucket were 50 basis points, then SM would be 50 basis points. Average that across the maturity buckets. Now that works for maturities over 1 year. For maturities under 1 year, there are special procedures because of the issuances are very short and very large, and they don't sit on bank loan books very long. So we have special procedures for under 1 year. I'm not going to have time to go over those today. At the bottom of this slide is a list of criteria for how instruments get into this this data collection, and I'm not going to go through that either. So I'm just going to move on and talk about, illustrate some properties of this index. So here, for example, is the mix of transactions volumes in the longer term maturity buckets, the 1 to 2 year bucket, 2 to 3, 3 to 4, and 4 to 5. And you can see that in terms of transactions volumes, they're quite volatile, and they do change across maturity buckets. The mix changes across maturity buckets as you move forward in calendar time. What you're seeing here are the credit spreads, what were called SM in my previous slide, for each of the maturity buckets historically. So in the top left diagram, the line plotted is the average of credit spreads of instruments issued by banks that have a maturity between 1 and 2 years as it varies over the last decade. And sectionally across banks, you can see the interquartile range in blue. So the first quartile and third quartile credit spreads are shown in blue. You can see that at some points in time, there's a wide cross-sectional variation across banks. And we are using the median when we construct our across the curve average. So we're going to end up taking the weighted average of this bucket, of the 2 to 3 year bucket, the 3 to 4 year bucket, and the 4 to 5 year bucket. And the weights are based on trailing issuance. So there's 2 different weighting schemes involved, as you've noticed. One is within a maturity bucket, you're weighting by transactions volume. And then across maturity buckets, you're weighting by trailing issuance, so that you get, by using trailing issuance, you're getting the marginal cost of funding over the recent time. In terms of trailing annual issuance, this is the whole point of an across the curve index, which is the way that banks fund themselves across different maturities varies quite dramatically across time. As you can see in this diagram, the amount of issuance in the 4 to 5 year bucket is sometimes quite low and is sometimes quite high relative to the amount of issuance in other maturity buckets. And if banks are changing the composition of their funding, then you would want to change the weights that you place on these different credit spreads because you want to capture their average cost of funding. Remember, banks are not funding hardly at all at 3 months anymore. So if you're going to declare victory because you have an index that's very close to 3-month LIBOR and very accurately close to 3-month LIBOR, then don't declare victory, because it means that you're capturing accurately a credit spread, which is just not that relevant anymore to the true cost of funding for banks. Now, someone might say, well, you know,
sorry,
you've got a lot.
Sorry,
Yeah.
when you give this fraction that you just showed, does this include repo?
No, because repo doesn't have a maturity of 4 to 5 years, and it's not unsecured, it's secured. So these are only unsecured. The presumption is that, Rama, when you come to my bank and you need funding, I've already gotten all my repo funding that's possible. The additional funding that I'm going to get to fund your loan is by going out into the unsecured funding market.
Okay, so this is the bond issuance or other
Right.
debt.
Unsecured wholesale bonds.
Okay.
And then in shorter maturities from 0 to 1 years, it's unsecured commercial paper, certificates of deposits, bankers' acceptances, things like that. Okay, so what I've shown you so far is the blue line called AXI, and here it's plotted from December 2009 to the end of last year, or now the end of 2019. And you might say, well, yeah, that's capturing the costs of funds of banks, but the amount of transactions is not overwhelming. You've made it a lot bigger than the LIBOR pool of transactions, but it's still not that impressive in terms of total transactions. What about if you went to the wider pool of corporate investment grade corporate debt? If you did that, you would get the red line, which sometimes differs from the blue line during stress periods, like this is the Eurozone debt crisis right over here. But in the last 5 years, there's really not much difference between the blue line and the red line. And so if you want to broaden the pool of underlying transactions, it's really not going to do that much damage to just go to all investment grade corporate bonds. Now we're not actually pushing that, but it's an option because again, it makes the index that much more robust statistically and that much more robust to manipulation. And anyway, I'm not sure that your borrowing customers would be all that pleased if you sent them an interest rate invoice at the end of this quarter based on a 300 basis point credit spread, simply because banks found it very much more expensive that quarter to fund themselves. So maybe you want to mute the volatility of the blue line by going to a broader set of transactions, which is more smooth. That's a judgment call. If you broaden the transactions, as you can see from banks, which are in blue, to include other financials in red, and then non-financials, all investment grade, you can see how much larger the pool of transactions is. It's on average 5 times bigger pool of transactions, which means you have an index that's 5 times more robust in that sense. Okay, so that's the end of the first segment of this. I only have 2 more slides, but the next slide, which is based on my work with Zachry, is going to take me a while to go through. It's going to motivate, do these banks, these banks in the United States that are saying, wait a minute, we don't like SOFR without a credit spread index, is there any merit to their suggestions that if they don't have a credit spread, then basically their costs of funding their loans will be so large that the loan market will not perform as well. That's basically what they're saying. I mean, of course, they have a conflict of interest. They want more loan revenue when their funding costs go up. That's a hedging motive. In principle, they could embed that extra cost into the pricing of their loans. But is that going to be efficient? And Zachry and I are coming to the conclusion that there is some additional efficiency gain in terms of total allocative efficiency of lending markets if banks do use a credit spread index in their lending. And I want to take you through how that the use of a credit spread will reduce a friction in bank lending markets. And this is preliminary work. We don't have a paper yet. We don't actually even have any empirical results yet, but Zachry has been digging out lots of data and supporting evidence. And we have an underlying theory that's quite sound. And so we think we'll have something real to show you in a few months. But you know how research goes, it's a risky business. What I want to do now is just to give you a 1-page description of the motivating economics of why these banks that want to use a credit spread index have a good point. Remember, no UK banks have made this protest, but over here in America, people like protesting. Okay, so here we are. I'm facing Rama again. I'm the bank, he's my borrower. And we're going to focus on the most obvious case, which is a revolving credit spread. So it turns out that a very large fraction of corporate borrowing in the United States that's floating rate, that therefore is relevant to what we're discussing, is actually in the form of credit lines or revolvers, which means I'm going to give Rama, let's say $500 million credit line. He can draw on it whenever he wants over the next 5 years. And when he draws on it, he's going to pay at a floating rate ZT plus a fixed spread, like 150 basis points, because it's Rama and he's pretty good credit quality. And the question is, well, what kind of a floating rate ZT should you use? How about SOFR? How about LIBOR? How about the index that we're proposing? Does it make any difference? Well, of course, when you add a credit spread, Rama has to pay more, but we could just reduce his fixed spread correspondingly, and we could make ourselves whole for that. But that's not the point. The point is covariance. The key issue here is the covariance between the credit spread on my bank's funding costs and the net amount, which I'll call U of ZT, of funding that I need after when Rama exercises his right to draw on this line of credit. So again, UZT in some future quarter T is the net amount of funding that I need to support the draw that Rama makes on this line of credit. So if Rama draws out of the 500 million line, if he draws 400 million in the June quarter of this year, and of that 400 million, he deposits 100 million back in my bank, and the rest of it I have to fund from somewhere else, then U of ZT for that quarter is $300 million. So U of ZT is the net funding that I need all in to service this revolving line of credit. And it's this, again, this credit sensitivity group of banks that is saying, wait a minute, if the floating index ZT is just SOFR, then Rama is going to draw a lot of funding when SOFR goes down and my credit spreads go up. That's bad news. But if my floating credit spread, let's say LIBOR or my AXI index is embedded in ZT, then I will benefit to the extent that Rama draws when ZT is a big number, because he's going to have to pay me that interest rate. I'll let you all digest that for a minute. Let me repeat the point. If Rama comes to me in the June quarter and says, I want to draw 400 million, if it's SOFR, I'm going to say, darn it, because I got to go fund that. And I'm only getting SOFR interest rates, which are really low. And this quarter, my credit spreads are really high. I'm going to have to pay a lot of funding costs. This is terrible. If, on the other hand, the contractual interest rate on Rama's line of credit is, let's say, LIBOR, if my credit spreads are a lot higher in the June quarter, then probably LIBOR is a lot higher. I'm the Bank of America, after all. I'm one of the big banks that determine LIBOR. So if Rama draws 400 million, he's going to have to pay me LIBOR plus 150 basis points. I'm going to get a nice big fat LIBOR interest payment from Rama. That's going to offset a lot of my funding costs. That's good. Okay, so that's the point of this covariance effect. This is what the banks have been saying, but they haven't provided any supporting theory. That's where Zachry and I come in. So I did some previous work with actually somebody at the Bank of America, Leif Anderson, who's a famous quantitative finance expert in interest rates. He's an executive in their derivatives area. And he and Yang Song of the University of Washington and I wrote a paper that says there's a friction in financial markets associated with funding costs. And to make a long story short, we can talk about this in discussion. On top of the market value of the loan that I'm providing to Rama, or the line of credit I'm providing to Rama, I'm going to need to charge him extra to offset the cost to my bank equity shareholders of the funding costs associated with that loan. Let me repeat that. This is a wedge. It's a friction in markets that, because of the capital structure of banks, which includes things like credit spread effects, it includes capital requirements and other things. Because of that, there's a wedge or a friction such that when I need to fund Rama's loan, it's going to be an extra expense to my shareholders above and beyond the cost to my balance sheet. The banks are calling that extra adjustment a funding value adjustment. This is an inefficiency in markets. And the cost that I have to charge back to Rama to make the loan economic for my shareholders is given in this formula. It's the risk neutral expectation of the sum over the maturity of the line of credit. Of course, there's an indicator of whether I survive to each maturity point. That's a minor factor. Then there's a discount factor. It always shows up in risk neutral pricing. But then we get the key effect, which is the amount of funding drawn times the credit spread on my wholesale unsecured funding. So this is my actual cost of funding when I go into the market. That's ST. The discount factor delta T, well, there's some covariance effects in there. There's some covariance effects with survival. Let's just put that aside. The really interesting thing on which Zachry and I are focusing is the cross moment effect between the amount of funding U of ZT and my credit spread ST on funding. There are very important effects in here that suggest that it would be efficient to lower this funding costs by making ZT positively correlated with ST. Why? Well, because if ZT is positively correlated with ST, then whenever my funding costs go up, I'm going to get a covariance benefit associated with this reduction in funding costs, which is the expectation of U times S. So I'm going to be offering at the, back when I offered this credit line to Rama, I'm going to be saying, gosh, it's a good thing that we put a big credit spread component into this line of credit contract, making our index linked to LIBOR or across the curve index or one of the other proposals, because that means that the adverse covariance effect of Rama drawing on the line just when my costs of funding go up is reduced. And that's a benefit. And what Zachry and I are doing is quantifying that benefit. That's basically the whole purpose of our research paper, is to estimate for practical cases this risk neutral expectation of the net amount of funding drawn times the credit spread of a bank. That's what we're doing in our paper. Of course, we're also supplying the underlying conceptual motivation and some of the evidence that goes with this. So that's a long story, but that's what we're doing. Zachry and I actually have a meeting this afternoon to talk about the next step in our research project. Okay, now let me summarize and then we'll take Q&A. So here's my concluding remarks. The AXI, or across the curve index, is an index of credit spreads on recent wholesale unsecured debt funding. And in the US, that's for publicly listed US bank holding companies and their commercial banking subsidiaries. That's what it is. I just explained why it may be valuable to include AXI or LIBOR or some other credit spread index in loan contracts, because that adds economic efficiency to the loan market. It means that I won't have to charge Rama an additional add-on that will discourage borrowing inefficiently if I have this kind of a credit spread embedded in my loan contracts. That's good. Doesn't have to be LIBOR. LIBOR is going to disappear, and it's a good thing that it is. It could be AXI, or it could be the new Bloomberg proposal. It could be a new proposal by the ICE benchmark administrators. And we're just putting forward one example of an index which has nice properties. It is correlated with funding costs. By definition, it's the average funding spreads for banks. It is robust because it captures a much wider set of transactions than those underlying LIBOR. By definition, it includes everything pretty much. And it's adjusting dynamically with the maturities at which banks are actually funding themselves. So it's not a constant maturity mix. It's a dynamically adjusting maturity mix that gets the actual average wholesale unsecured credit spreads of bank funding. And when we build this, we're using data filters that try to strike a balance between getting a homogeneous set of bonds and keeping as many observations as possible. And that's described in a white paper about this index that you can find on my website or on SSRN. If you decide that incorporating investment grade corporate bonds generally doesn't bother you too much, that's a good idea because it's highly correlated with bank funding costs. It's almost the same over the last 3 or 4 years. And moreover, you get about 5 times as much data. So it's much more robust to statistical noise and to manipulation. So that's the end of my prepared discussion, Rama, and I'm happy to take any questions.
Thank you very much, Darrell, for this very interesting talk. So we have now time for questions or comments. So let me also thank our sponsors, Mosaic Smart Data and Citi, sponsor of this seminar. I forgot to mention that in the opening statement. Okay, so we have now time for questions. Questions, anyone?
Very quiet.
I have a quick question. So Andy Dickinson from Bank of America. So it's very interesting. Thanks for the talk. The one question I had was, I think there was a secondary concern from regulators, which was that having lending linked to LIBOR when funding spreads blew out during the crisis sort of undermined monetary stimulus because they were reducing interest rates. LIBOR OIS was blowing out at the same time. What are the regulators' thoughts on linking this the level of lending rates to something that's credit risky?
Well, that's an additional disadvantage, which is that if credit spreads are blowing up inefficiently, that is, if they don't represent the actual credit costs, but they also represent financial instability costs, and so they distort the prices of floating rate loans, then that would be bad. If they go up merely because banks are riskier, then that's not inefficient. That's efficient. But if they go up because markets are not functioning properly, then you could, as the premise of your question suggests, you could stifle lending because borrowers are facing huge borrowing costs, or for existing legacy loans, corporates could have really elevated interest expense. That would also not be good. So that's a disadvantage relative to, let's say, SOFR or SONIA, which are quite muted and typically in a financial crisis. And I just think that's a very good point. It's actually not raised very often. I haven't heard regulators talk about it very much. Mostly regulators are concerned about LIBOR because it's not that robust. What is your view, Andy, on this? Do you think it's an important enough consideration?
I think it was a secondary concern, I think, because LIBOR OIS blew out quite spectacularly during 2008. And I think it was, my understanding was that, well, maybe it's not regulators, maybe it's more central banks that were, I think it was contrary to what, it undermined the,
Sure.
The efficacy of the monetary stimulus. I mean, right.
It's about monetary policy transmission. When the central bank lowers rates to stimulate the economy, they want rates to go down. And if LIBOR is embedded in corporate loan contracts, then in effect, rates have gone up. But there's a reason, there is a good credit risk reason that you would want costs of funds to reflect any credit spreads that are, credit risk that's actually there. What you would not want to include is the inefficient elevation of LIBOR associated with market dysfunctionality. So I think it's a valid concern. As you know, during the financial crisis, LIBOR didn't go up nearly as much as it was supposed to have because banks underreported borrowing costs when they determine the LIBOR pool. And it's estimated to be about a 50 basis point effect on average for 6 months, which is quite a lot. Yeah, I mean, good point.
Thanks. And I think and in terms of the correlation effect, I think I think you're almost certainly right. I think it's right way from the perspective of the banks. That's all for me. Thanks.
Thanks, Andy. Appreciate that.
Hi, Darrell. Can I ask a question? Vladimir Peterberg here.
Yeah, Vladimir, good to hear from you.
No, great talk. Thank you very much. So the point of not having a term structure of spreads is, I guess, to have enough transactions to have a robust benchmark. Is that basically it?
There are two reasons. One is if you're going to embed the same index in all of your loan contracts, then you would want it to reflect your average marginal cost of fund, the average across your issuances of your cost of funds, not just your 3-month cost of funds. So for that reason, you would want to average across credit spreads at different maturities that you're issuing. So that's one reason. The other reason is the one you mentioned, which is it gives you more transactions, so it's more robust.
So, okay, I understand that. But in terms of derivatives, right? So as you mentioned, once you have floating rate in a loan, somebody will want to swap it for fixed and so on, and have probably options on that as well at some point. That kind of makes it a bit more difficult for us, kind of simple derivatives quants, if you don't know the maturity of the credit spread, essentially, that you're trying to write a derivative on.
Yeah, it makes it harder for you to model and also to lay off in a kind of systematic maturity dependent buckets. I actually talked about this with your collaborator, Leif Anderson, and your co-author, and he and I joked about it. I suggested that that you quants are really up to this task, and there's nothing in economics that says it has to be at a fixed maturity. In fact, this index, I said to Life, could be anything like, you know, the hog belly production of Brazil, and it would still not destroy any of your mathematics. It would just make it more complicated for you.
Yes, I have to agree there. It will keep us, I guess, more employed, I guess, for longer.
Right. That's right. It does make your life more complicated, but there's nothing wrong with it per se in terms of the modeling. As I said, you could use the average daylight temperature in Hawaii, and the mathematics still works. It's just a question of being able to get good models of it.
Just to follow up on Vladimir's question, so I think this links to your penultimate slide on this covariance term, right? Because it's true you could use you know, rainfall in Hawaii, but then the covariance would be probably 0.
That's right. That's why you want to make it correlated with your average cost of funds.
Okay, so that's, I think that relates to Vladimir's question, because if you just use an average across the whole term structure, then it might that will decrease the covariance with the specific lending volume.
No, it'll actually increase it. The covariance that we're looking for is covariance with my average cost of funds. So when you do that $400 million draw on the line that I offered you, I'm going to go out into wholesale credit markets and I'm going to get $400 million of funding. And I'm pretty sure I'm not going to get it at 3 months, because that's going to destroy all of my regulatory metrics. I'm going to do what banks have been doing for the last few years. I'm going to get it at a range of maturities, including longer term maturities. And my cost of funds is going to be a mix on average across all the borrowers that come to me in the last few weeks. It's going to be a mix across different maturities. So that ST in the formula is not going to be a fixed maturity credit spread. It's going to be a credit spread that's a weighted average of all of my sources of funding. And so if I want to get the best possible covariance effect, I want to make my ZT contractual spread correlated with ST, my average across the curve credit spread. Now, if I'm a bank that always funds it 1 year, then yeah, I would want to use ZT to be a 1 year sort of credit spread. But if I'm a bank that funds at various maturities, as most large banks do, then I would want to reflect the average maturity mix.
Okay, so you're saying if the volume of borrowing reacts to some macro factor, which is the driving factor behind this your spread, then it's fine. You're going to capture that covariance, and you're going to be fine.
Yeah, there are two effects. One is, how does the amount that you draw on the loan covary? And that could covary with a lot of macro things. And then the second thing is, when I do the funding of that, at what maturities do I get funding? So that's the covariance between the U and the S. And that's what's motivating the work that Zachry and I are doing, is to try to make U and S highly negatively correlated by making Z and S highly positively correlated.
Okay, but I imagine, for example, if I'm a commercial bank and my main, the main source for my U is, for example, issuing mortgages, then, okay, these may be in a specific range of maturities. There may not be anything on the short end. They may be all, stuffed into a very narrow range of maturities. Then that's a case where, having an average across maturities might decrease the covariance. But I guess you're more thinking about investment banks or banks which have large, broad range of spectrum of activities, so they don't really have a target in terms of maturity, right?
I'm thinking only on the liability side of the bank. So where does it get its unsecured funding? The U part is how much funding is drawn net of the costs, net of the, basically there's going to be revenues in that funding. So if your interest payments to me are going to go way up because Z moves up with LIBOR, then I'm going to say, hooray, I'm so delighted that Rama drew on this $400 million line of credit when my credit spread is high, because this line of credit is linked to, let's say, LIBOR, the Z may be LIBOR, and that's going to offset my funding costs. If Z was instead set to SOFR or the overnight, whatever, treasury rate, I would say, darn, Rama's only paying me a piddly 5 basis points of interest on the floating component of my revolver, and I have to go out and raise funding at 150 basis points. That's killing me. That's exactly what the credit sensitivity group banks are complaining about to the US official sector. They hate it when they have to go out and fund in expensive credit markets loans that are only producing tiny interest spreads because they're linked to SOFR, which is paying almost nothing in stress periods. It's actually, not only is it no good positive correlation, it's actually negative correlation, because in real stress periods, as Andy mentioned, the central bank is lowering risk-free rates, but credit spreads for banks are going up. They're moving in the opposite direction. So it's negative correlation. That's your enemy with respect to this funding cost adjustment.
Any other questions for Darrell?
Yeah, I just had a quick one, if I may. How does the
Can you please introduce yourself?
Yeah, I'm sorry, it's Chris Murphy here. How does the multiplicative factor work on, I guess, the X or the AXI index? So is that set on a contract by contract basis? Is that determined by the maturity of the index? I mean, how do you see that working?
Yeah, it's going to depend. So if you're making 3-month floating rate payments to me, or Rama is, and my across the curve index has an average maturity of, let's say, 2.5 years or 2 years, then I want to scale down that credit spread to reflect the difference. And so if you come into my bank and you ask for a 5-year floating rate loan with 3-month floating rate components, 3-month tenor interest payments, I'm going to scale down my across the curve spreads by a pretty big factor. And the illustration that I gave you on my slides was to scale it so it's the same as, on average, 3-month credit spreads. So I would scale the 2.5-year credit spread down. Now, of course, that only works on average. So it'll be I'll have to change that scaling coefficient every now and then. So maybe every year I say, okay, for the next year, my loan contracts are going to scale my average across the curve credit spreads down by a factor of 4. And then I'm going to add a borrower fixed component. And then a year later, I might say, this year, I'm going to scale them down by a factor of only 3, because that gets me closer to 3-month LIBOR. That's another thing that Vladimir's co-author, Leif Anderson, and I were discussing, which is this awkwardness of having to change that scaling factor from time to time. You could also change it on a borrower-specific basis. So for Rama, he could say, well, I don't want any volatility hardly at all in my floating rate payments. And I could say, well, for you, Rama, I'm going to scale my credit spread component way down, and I'm going to add to your borrower fixed spread. And then
I guess the purpose of my question, what I was trying to drive at was, should that be set at the market-wide level so that you can encourage a market for fixed versus risk-free rate plus that add-on? Or would you have a derivative market which was risk-free rate versus fixed, and then fixed versus versus the AXI, and then everything is on a contract by contract basis? So I guess you could fix that coefficient per 3-month or 6-month reset across the market, and you could have a mechanism for doing that to scale that.
that is a super good question. It's very perceptive, and it's a source of tension. So let me suggest that I would strongly advocate the latter. That is, you would have one swap market for SONIA versus fixed, and another swap market for the credit spread floating rate index versus fixed. And then you can mix and match as needed. So you can make your scaling factor vary by borrower or over time. You're always okay as long as you have 2 swap markets running. The reason you don't want to have one fixed a combination of SONIA and the credit spread index is that that combination will take on a life of its own. It'll be called whatever, the Chris Murphy index. And people will say, great, we don't need 2 swap markets. We can do it all on the Chris Murphy index. And that's great. And then someone is going to at some point say, gosh, the Chris Murphy index market has now grown to 200 trillion notional. Is that okay? Because it seems to me the underlying for that is not that robust. And then someone's going to say, oh yeah, we were doing this before with LIBOR.
Yeah, please don't ever call it the Chris Murphy index, by the way. But I think there's an added benefit to having the 2 derivative markets separated, and that is that you then have concentrated risk markets in just that one index, right, across the curve.
Totally agree. And it's only likely to be used for hedging or speculating on bank funding costs, as opposed to I won't call it the Chris Murphy index, the combined index, which is one number, which could be used just like LIBOR was for anything and everything. And there would be a vast agglomeration of liquidity on this new substitute for LIBOR. And we would be back into this terrible situation we had with LIBOR, where everything was resting on a number that wasn't very robust. So I totally agreeing with the benefits of separating the 2 markets.
Thank you.
Okay, well, thank you very much to Darrell and to our participants. Thank you for sharing your time with us, sharing your ideas with us. And see you all next month for our next seminar.
Thank you, Rama.